All right. Good afternoon, everybody. My name is Joe Bloodgood. I'm a partner with Boulay Financial Advisors, and today with me again is my colleague Nathan Faith. We're happy to be with you. This week, we wanted to have a short discussion about what are some proactive steps we can be taking in an environment where the market has been seemingly so uncertain and so volatile. Nathan, how are you doing today?
Doing well. Thanks, Joe.
Great. Well, as we mentioned, the last couple months have really been an uncertain time in the markets. I think everybody understands kind of what that catalyst was to start things. But as we think back over the last couple months, as we think about the market, and if we think about it in terms of the indices that we think about, whether it be the S&P or the Dow, we've seen really dramatic moves both ways. Back in early March, kind of throughout that month, we saw a big decline. And then since then, actually, we've seen a really strong sort of turnaround in the market. And it's all happened really quickly and seemingly without any news as a catalyst there. So, Nathan, I know one of the things we wanted to do today is talk about, in a time where it's so hard to sit still and not do something that hurts our portfolio, what are some things we can be thinking about and doing that are actually going to benefit us in the long run?
Right. Yeah, the key with managing our wealth is to have a plan, to really foresee the future as best as we can so we can take action now, especially when we're all feeling that pit in our stomach, because that pit in our stomach is our fear, our thoughts, our feelings, our emotions, which, believe it or not, tend to lead us to do the wrong things at the wrong time and really is the most significant negative impact to our wealth. So what we're going to talk through are some action steps that we can take that really go against our gut feeling and our emotions, but over the long term have historically proven to work and work really well.
Awesome. Well, let's talk about it.
So what we'd like to do is start really with some waypoints that we all can track. And what most of us track is really what the stock market's doing. So what types of things should we be thinking of or steps should we be taking when, say, the market's down 10%, which happens about once per year, almost every year. So the number one step, which hopefully the majority of us can do, is really just sticking with our investment plan that we had going in. It does take a lot of courage and it feels like inaction, but sticking with the plan is how you preserve your wealth over the long term. But then what to do if you really want to take additional steps? This is where we need to have a bit more courage and go against our gut instincts. And so, Joe, I'll let you lightly speak to the next two, and we'll go into more detail here in a little bit.
Yeah, absolutely. So the first thing to think about, and you hit it on the head earlier, Nathan, the biggest thing you need to make sure you have is a plan, because without a plan, we tend to sort of act on our emotions. But when we have a plan and we have a targeted allocation, we can make sure we stay in balance. So for example, if we start out with 50% stocks and 50% bonds, and the market moves 10%, we can very easily rebalance back to those targets by selling what's in excess and buying what's now less than our targeted allocation. Additionally, beyond that, what we can do now is look to see what we have available for investable cash. So many of our clients operate in an environment where they've got either short-term fixed income or cash sort of on the sidelines, ready to take advantage when things present an opportunity. And with a decline like this can be a great opportunity to sort of take a first step and shift that first tranche of cash into the market.
And so the biggest cost to our wealth is oftentimes our own emotions, but a close second is really what Uncle Sam is going to tax us as our wealth grows over time. And so that final piece there has to do with minimizing your long-term tax burden when our tax cost goes down with the markets. So with that, we'll actually talk through these steps here in a little bit more detail, specifically regarding rebalancing.
Yeah, so like I mentioned earlier, rebalancing is something that's easy to conceptualize and harder to actually pull the trigger on when you're in the middle of something. And so we'll use what's happened recently as a prime example. If you held 50% bonds and 50% stocks in the middle of February, by the middle of March, you didn't have 50% bonds and 50% stocks anymore, right? That allocation shifted, stocks declined in value. The bond portion shifted, and maybe now you have 60% in bonds and 40% in stocks. Well, the easiest action step there you can take is to simply sell off enough bonds to bring that back down to 50% and purchase with those dollars what turned out to be stocks at a good value. So you shift those dollars from bonds over to stocks and take advantage of what we hope are lower prices in the long run.
And so those are opportunities we can take when markets are on sale. But what can we do when taxes are on sale? So really, what is a Roth conversion? High level, our wealth can be concentrated in three types of accounts. So there are accounts that we're taxed every year on, brokerage accounts, accounts that we're only taxed when we pull money out, think of your IRAs and 401ks, then accounts that we're only taxed when we put money in, but never again, being Roths. So what a Roth conversion is moving money from our green accounts to our orange accounts and paying a tax through that action, typically from the blue accounts. So it's good to have a good mix. So tactically, what you can do when the markets are down is make that move, because if you had, say, $100,000 in your IRA and now it's worth $90,000, the tax is obviously going to be less when the value is lower. That's what you can do tactically year by year if the markets are down. But strategically, what's the plan? We really have to know what our tax cost is and what it may be down the road. So what we do with our clients is look at the landscape with our tax planning. So on the left-hand side of the screen is a view of the tax rates married couples paid a few years ago, and what likely they will pay again when tax rates revert back to their old ways in the year 2026. But on the right-hand side is the landscape for a married couple right now and for the next 5 or 6 years. And what you can see is there's a big change in the width of the tax brackets, and of course the tax cost per dollar on either side. So with your planning, it's important to identify where your income's at now and where your taxes are now, but also to fast forward and look ahead at where you may be down the road, specifically in retirement. And if your tax cost is a hotter color, a higher rate down the road, makes a lot of sense to take advantage of any tax bracket that's below your future rate now. So commonly, our clients are drawing their lines at the top of the 24% bracket because they know in retirement they'll likely be in the 25% bracket or higher, which means many of our clients are converting hundreds of thousands of dollars to their Roths every year, whether the market's up or down. That's their plan. So that then leads us to what can they do if the markets provide opportunities year by year. So the next step is, what if the markets correct? Or excuse me, what if the markets experience a bear market being down 20%, which happens about every 3 to 4 years. It's common enough, but it's scary. So step number one is to stick with the plan and follow the previous action items. But then, Joe, do you want to speak to the next step of escalation?
Yeah, absolutely, Nate. So, in the previous step, when the market was down percent, we talked about rebalancing back to the target. If we do go through an experience where we have a bear market, where let's say the market is down 20%, one of the things we can do proactively there, let's say our target is at 50% stocks and 50% bonds, like the previous example. One of the things we can do is actually over rebalance. So as the bond portion of the portfolio has grown and the stock portion has shrunk, rather than 50-50, we can even do more than that. We can say, well, instead of 50-50, let's go all the way to 55% stocks or 60% stocks and sort of take a larger bite of the apple, with the hope that we're buying those securities at a discount, essentially on sale. We're able to buy more with the dollars that we have, with the idea that we're going to benefit from the long-term appreciation of those positions.
Yeah, and to that point, if we're going to be considering shifting our portfolio mix, it makes a lot of sense to also shift how our accounts are concentrated by taking these next steps. So if your goal, your strategy each year is to convert, say, $100,000 to your Roth, once the market's down 20%, that's where you kick on tranche number 2 and convert another third of your annual target to your Roth while the markets are down. So step 3 is a look at when the markets are down, say, 30%, which happens about once a decade. We actually experienced this back in March. One thing to recognize is as the pain is experienced with the markets, those losses have occurred and can't reoccur. And so even though the pain is going up, the probabilities that we'll experience more pain are actually going down, and the long-term returns from stocks and bonds are shifting more in the favor of stocks. So of course, next steps, if you're disciplined and courageous enough, is to stick with items 1 and 2, but then continue to escalate with the next strategy. Joe, do you want to speak to this?
Yeah, I guess I would just add a couple things here. Sticking to the plan a lot of times is the hardest part. But like you said, if you can grit your teeth, now can be an ideal time to what feels like extend your risk. But in reality, what we're doing is we're putting more of our capital in an area where we have higher probabilities of future returns. So we're shifting money here again from the bond portion or the conservative portion over into the risk-based assets, and maybe we bump that up another 10% in this scenario.
And then, as you likely predict, once the market's down 30%, go ahead and top off your Roth conversions for the year. So if your target was $100,000 for the year, regardless of what the markets would do, if the markets provide this opportunity, go ahead and hit that max of your $100,000 Roth conversion. What about if the markets continue to go down? Our goal is not to time the bottom. That's impossible to do, but to dollar cost average into it if it continues to go down. And so if the market's down 40%, which for reference, when the financial crisis hit this threshold back in 2008, we were about 6 months away from the actual bottom, which seems like a long time, but 6 months goes by quite quickly, and we didn't go down much further from there. So of course, continue to follow the steps that you have previously up to this point, but if you have the discipline and the courage, Joe, do you want to speak to the next step?
Yeah, you bet. Same theme, right? So your portfolio has naturally grown more conservative by the fact the market is down 40%. It's no longer that 50-50 split. So now, again, as strange as it may feel, is another ideal time to put some more of your resources towards purchasing those risk-based assets.
Yeah, and the next step with the Roth conversions is actually start bunching Roth conversions. Do multiple years worth in one fell swoop. So if our goal is $100,000 per year, now it's worth considering doing, say, $300,000, $400,000, or $500,000. As long as you have the cash to pay the eventual tax bill, it's a wonderful opportunity because your tax cost to convert those dollars has nearly been cut in half at this point. And our final step is, what if the markets are down 50%? So this does happen every 20 to 25 years on average. It happened during the financial crisis. But when the market hit this threshold, it was only 2 weeks from hitting the bottom, and it then shot up from there. It didn't take that long for the market to then double from the bottom. So the risk and the probabilities are now more in a client's favor than they obviously were with the previous 50%. And this is where the smallest minority of folks would actually get to this point. Because this is where fear is at its greatest, and it really takes a firm understanding of your plan, your tolerance, and your capacity to implement these strategies to take these next steps. So, Joe, you want to just reference this final one?
Yeah. If it hasn't been clear already, again, here's another opportunity to take advantage of stock prices that are now half of what they once were. And so, to the extent you have the ability to do so within your portfolio, shifting more dollars the direction of stocks would be certainly an opportunity when markets are at this level.
And this would be a shift where if someone was in a 50-50 portfolio originally, now they'd be in an 80-20, 80% in stocks, 20% in bonds. When it comes to vaccinating our wealth from Uncle Sam, these types of opportunities just won't present themselves more than a couple times in a lifetime. And if one has the courage, any dollars that are in the green accounts, so the IRAs and the 401ks that you've built up over your careers, now is the time to back up the truck and convert all those dollars to your Roth IRAs, because the odds are heavily in your favor that the markets will rebound and rebound quickly, and all that growth in those accounts would be completely tax-free. So with that, Joe, do you want to speak to next week's topic?
Yeah, absolutely. Thanks, Nate. So our intention is to kind of keep this theme moving. And over the past weeks, we've talked about a couple of different topics. Next week, we plan to talk about appropriate uses for debt and how you might think about that and how you might deal with that as we move forward.